Since January 25, 2003, the spotlight has been on the Adani Group, following the release of a research report by a US-based research company, Hindenburg, which stated that the company and the group is highly overvalued, and they see a 85% downside in the listed securities of the group. They also alleged that the group has been involved in stock manipulation and accounting fraud. The release of this report has led to a crash in the listed securities of Adani, both globally and India, and has led to almost the Adani Group losing $100 billion in market cap in a matter of a week. Following the allegations from this report and the crash in the stock prices of the listed Adani Group companies, a lot of debate and conversation has been there around about the role of the regulators and what the regulators should be doing to protect the interest of the investors. If you want to know the details about the report and the Adani's response, I have done a detailed video on this, the link of which you can find in the description box and also in the I button. In this particular video, we will be talking about the regulator, that is SEBI, and how they have put in place a lot of mechanisms to ensure that the markets work in an efficient manner. So as a role of the regulator is SEBI, what it is doing and what it can be doing. Hello everyone, welcome to iExamB. If you like such videos, please don't forget to subscribe to the channel and press the bell icon so that we can help you with good content to help you prepare for your various examinations. And the agenda of this particular video is also educational in purpose. We are not trying to conclude who is doing their role or not, but to understand and learn for our educational purpose what are the various mechanisms that exist for the efficient working of the markets in India. So SEBI, as the regulator for the capital markets, performs three roles, key roles. The first being the protection of the interest of the investors. Second being the regulation of the markets. And third is to develop the markets, right, through good regulation and through good mechanisms. Okay, so we will look at certain mechanisms in this particular video that are already in existence and how SEBI keeps bettering them and improving them to further develop and improve the efficiency of the markets in India. So we have categorized this into two aspects: the regulations that exist in place and the regulations that are further being improved or being developed by the regulator. So one such important regulation that exists in our in the markets is the prohibition of insider trading. These regulating so as to ensure fair trading in the markets. The other is the prohibition of the fraudulent and unfair trade practices. The regulations related to disclosures of the beneficial ownership, the additional surveillance mechanisms that kick in with the help of the stock exchanges and SEBI wherever high volatility is seen in a particular stock or security, the free float market cap rules, and the review of credit ratings in case of any high volatility of listed securities. The other existing norms where there could be certain gaps which can be pulled, or new proposals that are being talked about by SEBI relate to short selling restrictions, the corporate governance norms. All of these are already in place. The short selling restrictions already exist in our market. There are a lot of corporate governance norms that already exist, and SEBI implements them through the LODR, the listing obligations and disclosure requirement regulations already. And now SEBI is also talking about putting some kind of responsibility and ownership on the stock brokers to prevent fraud and market abuse. We will talk about all of these in detail one by one. So let's start with the first one, the prohibition of insider trading regulations of 2015. The insiders are basically the people who are close to a company and are therefore privy to information before it gets public or known to everybody else. Now, these could include the employees, these could include the promoters also of the company, or the directors in the company, or any other business associate with which the company is into business operations and there are any changes being brought about in them. if such information, which is as of now private, which is as per the rules referred to as UPSI or unpublished price sensitive information. That means any information that is unpublished or still not public and has a possibility of having an impact on the price of the listed securities. This is known as the unpublished price sensitive information. If this is privy to any insider and he uses it for his personal gain by sharing this confidential information and actually trading in the stocks of the company, then that is considered as illegal and is prohibited. Why? Because it is against the fair trading practices. It is unfair and it will not give equal footing to everybody to be able to benefit from a certain news. And that is as a part of protecting the investors, the role of SEBI to protect the investors. Any insider trading is prohibited. Does that mean that the promoters or the employees of a company can never trade in the shares of the company or the securities of the company? Actually, no. This they can. However, that should be done with relevant disclosures and through the right process, right? So there are certain exceptions which are stated that, off-market transfers between insiders can take place. There can be transactions that can be done through a block deal on a separate window. And then similarly, there are a few other exceptions that are given by these regulations. The idea is that everybody should have equal opportunity to benefit from any kind of news, and therefore anybody who has some information which is still not public should not be able to take advantage of it. And any kind of dealings which the insiders are doing, they should be disclosed. So there are disclosure requirements related to them in place. The second important regulation that protects the investors from any fraudulent activities is the prohibition of fraudulent and unfair trade practices related to the securities market. These regulations focus, and of course they discuss and make it illegal to indulge in any kind of frauds or unfair trade practices which could take the manner of, say, creating fake appearances or holding or making any other person hold securities with the purpose of fluctuating or inflating the prices. Okay? So their intention is not to stay invested, but to actually have an impact or move the prices of the listed securities, or where the news are being spread which are fake in nature, or there are circular transactions being run within various related parties to again inflate or influence the pricing of the listed securities, or events of front running. So front running is also something like insider, where somebody who has news of an upcoming event related to a company which may be beneficial or not beneficial, and based on that news, before the news becomes public, you are entering into transactions to take advantage of it. So these kind of practices which are unfair in nature are again prohibited. So what can actually SEBI do by prohibiting them? So if such scenarios do come into place, then SEBI has a right, to investigate such companies, and in case found guilty, to actually then take punitive actions against those particular entities or companies or related people. So those are the powers that are available to SEBI. So in this particular case, if I take the example of Adani, actually if there is some stock manipulation that the company has been involved in, SEBI has the right to actually investigate. So that is what SEBI can do as a regulator. After these allegations, it is important to understand these allegations are not equivalent to conviction. So SEBI as a regulator, as an independent authority, can look into them, investigate, and if found guilty, take action against the concerned people. Okay, moving on to the next important aspect is the beneficial ownership. Now, beneficial ownership is defined under the Companies Act under Section 90, which basically says any individual who, acting alone or together, or even through trust or persons resident outside India, hold beneficial interest in a company. And this beneficial interest is defined as having at least 25% interest, or you have the power or influence over the board of the company. So if you have the power to influence the board and take the decisions, or you have at least 25% of the stake, either individually or together or through other certain trusts and persons residing outside, you are considered to be a beneficial owner. Now, what does this have to mean? So if we say one beneficial owner can be you are directly owning a particular stock and therefore you are the owner, and in some other cases there could be some other legal entity who is in between. Say there is a trust that is there who is the legal owner, but actually they are holding it on behalf of somebody else, and therefore in that case the beneficial owner becomes more important. So this concept of beneficial ownership was introduced, and this becomes relevant even for RBI to avoid any kind of money laundering. So beneficial ownership is also mentioned under the Prevention of Money Laundering Act. And in securities market, SEBI also has its own guidelines related to identification of beneficial owners. So SEBI requires that the intermediaries in between, say in case of foreign portfolio investors, the DDPs, the depository participants, they should do the KYC, and they should know who the beneficial owner is, who is the beneficial investor in a particular stock. Similarly, any company, when sharing their shareholding pattern, they should also disclose the beneficial owners in their shareholding pattern. So the disclosures about the beneficial owners and not just the legal owners is the requirement. This is again done to ultimately know who is owning, and actually that the companies are complying with the requirement of having at least 25% of public shareholding, right? What is this guideline? This guideline is actually that if any company is listed, at least 25% of it should be public shareholding and not with the promoters, right? So that is a requirement. So this beneficial owners disclosures ensure that the promoters are actually holding only maximum 75% and not more than that. Okay, through layers of ownership, right? So that is removing the veil behind who actually is owning and who is only owner in the name. The next very important mechanism actually to ensure market efficiency is the additional surveillance mechanism, and this has been in the news again because of the Adani Group, because these stocks were placed under the additional surveillance mechanism after the volatility. Now this is a simple mechanism that was introduced in 2018, and the intention of this mechanism was also to protect the investors from market volatility and unusual changes in share prices, right? So the idea is only to protect the investors and not to prevent and intervene in the movement of the prices, because the prices are market determined, which are based on the demand and supply. However, if they are becoming too volatile or the changes are too sharp, we are just monitoring them and surveilling them and ensuring and bringing it to the light of the people that there can be risk. So you can trade, however you should be aware about the risk. So what actually triggers ASM? The triggering of the ASM happens with the sharp movements. Now this sharp movement can be on either side, on the upper side also or on the lower side also. So to give you an example, the Adani stocks have been put under ASM right now because of the sharp decline in the prices. They have previously, 2 years back, somewhere in 2019, also been put under ASM because of the sharp upward movement in the prices, right? So ASM has nothing to do with only any particular side. It is about any kind of sharp movements. Second, and this is not the only parameter, there can be other parameters because of which a stock can be put under ASM, like client concentration. What that means is only a few clients are trading, and it is, and they are holding the entire trading happening in the market is only concentrated in their hands. Or there are market cap related movements that are happening, or there is a volume variation. All of a sudden the stock that was never traded starts trading in very high volumes or very low volumes, delivery based, so there is trading that happens which is settled on cash basis, or which are delivery based settlements, that is cash segment or the futures segment or derivative segment. So if there is sharp movement or sharp changes in that can also trigger ASM, or the unique number of unique pans. So these are some other parameters which are taken into consideration before putting a stock under the additional surveillance mechanism. What actually happens if a stock is put under ASM? Then, there are, as I said, it is to protect the investors from the market volatility. It is not to control the amount of trade that is happening. So we are just making them aware, and to make them aware about the risks involved, the margin requirements are increased. The upfront margins are collected. So trading on margins is restricted, and you may have to actually give 100% margin as against say a 20 or 30% margin to trade in these particular stocks. Even the price bands, on which different margins would be triggered or next action would be taken could be reduced. The settlement starts happening on a gross basis rather than a net basis. What that means is whatever the amount of difference or the settlement has to happen without netting off against any other trade that you may have done in any other stock, that will not be netted, but only on the gross basis related to the stock who is under ASM, you will have to settle the money. And also the stocks that are in ASM, they cannot be used as a collateral to raise money or take cash leverage. Right now in trading, in the stock market trading, people actually use their existing stocks, shares that they have as collateral to borrow money to enter into trade for other transactions, right? So you cannot actually use the stocks that are under ASM to use them as collateral. So these are certain restrictions that are put in place to protect the investors and make them aware that the risks exist, and you can take positions after being aware about such risk. So this is how the ASM is actually helpful, because after putting these restrictions into place, you are actually discouraging speculators, right? Because the speculators are able to work well when they are able to get leverage, or they are able to work on say a 20 or a 10% margin. But when they have to give upfront the entire money, their returns go down, and therefore the trading from them actually goes down, which helps to bring down the volatility in the particular stocks, because of the liquidity going away, which was very easily available to them before. They don't have that, and therefore they don't want to, and this discourages speculative trading and bringing down volatility. Another very, very important point to understand here is shortlisting of securities negative? As I told you, it is a step and a mechanism put in place to protect the investors from the market volatility. So it is not that it means that, something negative has happened. It is just an indication that, that you need to be aware about the risks, and there's a mechanism to help bring down the volatility. It is not any action being taken against the company. So this is a mechanism put in place for the efficient working of the markets by the regulator. Now, free float market cap. Now, free float market cap, why I'm talking about is important is because, the stocks that are included in the indices, right? Now, one particular stock should not have an impact on the entire market. Now, what we say, the entire market is reflected by the index. So in our country, two very important national level index are the Sensex and the Nifty. Right? Now, these are reflected how they consist of various other stocks, like Nifty has 50 stocks, Sensex has 30 stocks, and the stocks that are included in them are the highest market cap stocks, right? Also trying to spread out between different sectors. Keeping these aspects, these are included. But for the market cap, they also take into account the free float. and not the entire market cap. So what do we mean by that? Let me explain you first what is market cap and then what is free float market cap. Market cap actually refers to the value of all the shares of the company. So simply put, you can calculate it as the total outstanding shares into the market price of each share. Right. Now, free float, on the other hand, relates to only those shares which are available for public for active trading. So it indirectly does not include the promoter shares, because the promoter shares are not being actively traded in the market, right? So in that case, if the free float of the company is relatively less and there are sharp movements happening, the likelihood of the stock not being in the index is very, very high, which decreases the impact of individual stocks having the impact on the entire market, or the ability of moving the entire market in a particular direction. So this free float market cap, this doesn't only exist in India, but this is followed by all the stock exchanges globally. So this rule actually helps to reduce the impact of particular individual stocks on the entire market. Going ahead, the next is the monitoring and review of the credit ratings. Now, in many cases, credit ratings are basically done for the debt instruments and the debt that the company takes. In 2017, SEBI had introduced another guideline for the credit rating agencies, that if there are certain events that take place even in the stock markets, the credit rating agency should also review the ratings and see if that can have an impact on the debt repayment abilities of the company, right? So in this, many events were listed down, and one of the events was the significant decline in the share prices or the bond prices of the issuer. So for example, if we talk about Adani, the share prices have significantly declined. In this case, all the credit rating agencies which have given a credit rating to the Adani debt instruments will have to review and see if this can have an adverse impact on the repayment ability of the company or not. So this also triggers become a trigger point for the credit rating, so as to ensure that this movement in the stock market does not lead to a financial system crisis developing, right? So in case of Adani, CRISIL has rated it, and CRISIL has actually said that we are continuously putting monitoring and surveilling various entities, including the rating of the credit Adani Group entities, and that they are continuously monitoring if there are any corporate governance issues or any decline in their fundraising capability, because these will be the reasons for it to look at the credit rating. Otherwise, the company as of now has sufficient funds to be able to repay, but they will continue to monitor for the corporate governance issues and their fundraising capability. At iExamB, the faculty helps you to unfold your potential by clearing your concepts, by providing you crisp content in the form of short recorded videos and PDF downloadable in nature, and engage with you in live classes for any doubt clarification or for better understanding of different topics and news, which helps you to prepare 50% faster for your various competitive exams. Moving ahead, talking about the short selling restrictions. Now, this is not something that is new. This has existed in the Indian markets, and SEBI from time to time keeps coming out with different kind of rules and regulations and restrictions related to short selling. So before we move on, what is meant by short selling? Short selling is actually selling a stock which you do not own, right? So you are trying to sell something which you do not own, and you sell it because you think the price of that is going to go down, with the intention that although I don't have the underlying asset or the stock right now, but I will buy it when actually the price goes down, and that is how I will benefit. So I will sell high and I will buy low, to be able to make a profit from this particular scenario. Now in India, SEBI does not allow short selling in all kind of stocks. They only allow it to take place for the F&O. That means the stocks that are there already in the derivatives segment, only they are allowed to be short sold. Plus the entities who can, now institutional investors and also retail investors, both of them can do short selling. However, there are certain restrictions. One, when the institutes are doing short selling, they have to upfront disclose before, when they are placing the order, that this is a short sell order. And the retail investors will also have to disclose it, but this can be done by the end of the day of the transaction day than which they are holding. So there are those restrictions. From time to time, more restrictions can be put in place. Like during COVID time, there were short selling was banned. And many times margins are increased on short selling, and plus another important rule is that naked short selling is not allowed in India. What we mean by naked short selling is, as I told you, you are selling something that you do not own with a promise that you will buy in later, right? But how do you sell it, right? You sell it by borrowing, right? So say if I want to short the Adani stock and I don't have it right now, what do I do? So I will borrow it from somebody who has it, right? And I will give him back them once I buy it back and the prices fall. So I will actually, to be able to short sell, I will have to find somebody who owns and is ready to lend that to me, right? And brokers provide the services. They may help you borrow and give it back and lend you. Of course, you pay an interest for that, for the time duration for which you have borrowed. And naked short selling is when you actually don't even borrow, right? So that is not allowed, that is not permitted. So this also helps to control volatility, unnecessary volatility, and protect the investors from unnecessary risk associated with short selling. The other rules related to corporate governance. Now, these are very, very important rules, and these are being put in place by SEBI. The last review happened in 2015 by the Uday Kotak committee, which had put in a lot of corporate governance norms, and before that also in the form of listing norms, they have existed in the country. So corporate governance norms are stated under the LODR regulations, which is the listing obligations and disclosure requirements that exist. One such important regulation disclosure relates to the related party transaction. Now, related parties are basically parties which are associated and have some kind of fiduciary relationship with the company. And if a company is entering into any transaction with such entities, these need to be disclosed. Plus, these needs to be approved by the shareholders who are not related to the company, right? So this requirement exists. Now these norms were also made applicable to the high value debt listed companies in September 2022. What we mean by high value debt listed entities are the entities whose listed debt instruments, commonly referred to as NCDs, non-convertible debentures, if they are of 500 crores or more, they are in value. So then they are considered as high value debt listed entities. So if even if your stock is not listed, but if your debt instruments are listed and they are of 500 crores or more value, you will be considered as listed, and these corporate governance norms specifically related to related party transactions will also be applicable to you. As of now, our SEBI is looking into these regulations because many high-value debt-listed entities have represented to them that the related parties, the non-related parties, to vote on them do not exist, in which case they cannot approve the related party transactions. SEBI has now come out with a consultation paper to review these corporate governance norms for the high value debt listed entities to ensure how they can, disclose and take the relevant approvals. So in this case, the suggestion has been in place of the shareholders, where the non-related, the related parties are the major shareholders. In that case, the approval from the debenture holders will be taken, and these debenture holders should not be against such a transaction or a decision. So SEBI keeps reviewing its regulations to ensure that they are complied with and they are not becoming a hindrance for the functioning of the companies or entities. The next is now putting in place an institutional mechanisms for stockbrokers to ensure and prevent any fraudulent or market abuse. So the stockbrokers, or various stockbrokers or various other intermediaries exist, and they are monitoring the market participation. And the idea is that they can actually identify various instances or indications of fraud or market abuse that can be taking place. For example, any creation of misleading appearance of trading, any price manipulation, any front running, any insider trading or mis-selling that is happening, any spoofing or frequent changes in the KYC which is being submitted by clients. These are some indications that there is some intention or probable fraud that may take place, and the stockbrokers can have actually help in identifying them. So the mechanism or the framework is looking at identifying focusing on three aspects. One, the indicators list of certain frauds that can take place, which are the entities that can be looked at, and what can be the accountability matrix. To give you example, what you can see on the screen is, say, the creation of misleading appearance of trading. What are the factors that can be looked at is the potential connections and relations between the various clients, and based on the KYC, so if based on KYC, you can see there's interconnectedness, or there's a relationship between them, or the time proximity of orders being entered. So there's a list that has been given in this particular framework, which is trying to give an institutional mechanism where the stockbrokers can be involved to help identify any probable fraud or market abuse that can be taking place. So these are new things that SEBI is working on. So already there is mechanisms in place, plus SEBI keeps developing new policies and regulations to better improve the efficiency and to plug any kind of gaps that may be existing in the current regulations. So these were certain regulations that I felt were important. You can write in the comments box certain other regulations that you can think of that help SEBI perform its job as a market regulator. I hope this video has been helpful to you, and if you found it useful, please don't forget to subscribe to the channel and press the bell icon to help you prepare 50% faster for your upcoming exams. Thank you and wishing you all the best.